For most people, accounting scares them to death. But if you understand the basics, it's really not that bad.
Before we can understand anything about financial statements or journals, there's a few accounting jargons that we need to understand as well. For example, accounts payable. That's when we as a company owe an entity money, and the payable is kind of how it explains it. It's still to be paid, payable. The same when an entity owes us money, that's accounts receivable, because we still need to receive that. We have credit, and by credit, I don't mean your credit card. Credit refers to the right-hand side of accounting. So then the left-hand side of accounting should be debit. We have current, and that is less than 12 months. You'll see this with current assets or current liabilities. Current liabilities needs to be paid within the 12 months. It needs to be paid back. Then if you have equal or more than 12 months to pay it back, that would be non-current. Then we have a general ledger, and a general ledger is a book in which transactions are summarized and contain all debits and credits. So what book do we use to capture various transactions? That would be your journal. An all-in-one guide to the basics of accounting. Throughout this channel, we refer to the accounting cycle. In basic terms, the accounting cycle shows us all the steps that need to take place when dealing with accounting. But don't worry, each of these concepts will be covered in depth in this channel. This is just a basic overview. So, imagine you are the owner of Bright Gym, and in May you decide to expand your business by selling t-shirts to gym members. So you decide to buy 200 pairs of shirts for 20,000 Rand from Bright wholesalers. Once the transaction has taken place, a source document is generated. So please find a list of all the different types of source documents and an explanation of everything. But there's information that we can draw from a source document. We can see the goods or services that was involved, the price of that, the date, and then the parties related to this transaction. So from the source document, we record each transaction in a big book called the journal. The journal is the first book we use. Journal entries work on a double entry system, where two things need to take place. Something is received and something is given up. In this case, you receive 200 shirts and you give up 20,000 Rand. Each journal entry consists of a date, a count, a debit, and a credit. So, the 1st of May, you bought 20,000 Rands worth of inventory, the t-shirts, and you paid 20,000 from your bank account, so your bank is credited. Once the transaction has been journalized, it's recorded in the ledger. The ledger is a recording that keeps all the debits and all the credits on different sides, so that the balance of each account can be calculated. Just remember that the journal is merely the record of transactions, and that the entry into the journal must now be grouped into similar accounts of which the balance must be obtained. A ledger shows us a number of things: the name of the account, the corresponding entries to the account. So we debit inventory by 20,000 and we credit cash or your bank by 20,000, and then we get the total of each entries. So we can assume that you have been the owner of Bright Gym for quite a while, and your bank had 190,000 from the previous month. You bought the 20,000 rands worth of shirts, and now you have 170 left. But there's a correct way to close all accounts, and I'll show that to you at a later stage. As you can imagine, a big company like Bright Gym has hundreds of ledger entries. To solve this problem, the bookkeeper, that's now you, will draw up a trial balance. A trial balance will test the correctness of the double entry system. In order to draw up a trial balance, determine the balance and then post all the debits on one side and all the credits on the other side. And this too should always balance. This is because that for every debit entry, there must be a corresponding credit entry. And like I mentioned earlier on, that a business that grows will have numerous entries captured into the journal and then posted to the ledger. And this is where problems might creep in, because the debits and the credits might not add up. And questions that you can ask yourself as to why this is happening is, has each transaction been correctly recorded as either a debit or a credit and on the correct side? Have you lost track of what the balances of each account in the ledgers are and why the balances have been incorrectly calculated? So go back to the ledger, just make sure everything is calculated correctly, and then have you checked why the two columns add up incorrectly? Maybe you just forgot to make an entry, maybe you just switched two amounts around. But then there's always mistakes that a trial balance will not be able to identify, and that can be a transaction that has not been recorded at all, a transaction that's been recorded to the right side but the wrong account. For example, you post to vehicle account instead of the vehicle repairs account. A wrong amount recorded to both accounts, and then two mistakes that cancel each other out. So, at the end of an accounting period, the financial results of a business, along with the financial position of a business, are reported. These reports are summaries of the account transactions for the period concerned. The report is usually done in the form of financial statements. So we have the total profit or loss made in the period, as well as the assets and liability positions of an entity, and then the cash flow. First, we have an income statement. The statement merely reflects the results of the trading operation, meaning income minus expenses will give you your profit. The income statement is a financial history book, and this is because that anything that appears on here has already happened. Then we have a balance sheet, and a balance sheet is a list of your assets, your liabilities, and your equities. And just remember that liabilities plus equities is always equal to assets. Your balance sheet is often referred to as a financial snapshot. This is a picture of the business frozen in a moment of time, because what appears on the balance sheet is a reflection of the business at that instant. It does not and cannot show what happened to the business a moment before or what will happen to a moment after the balance sheet has been drawn up. Then we also have a cash flow statement, and a cash flow statement tracks the inflow and the outflow of cash in your business. And you can either use the direct or the indirect method, but I'll explain the difference between those two also in a bit more detail. Then we have the analysis and interpretation. The users of the financial statement will interpret and analyze the information that they contain. The profit and loss is considered in relation to the activity of the business, the money invested, and alternative investment options. This is called a general ratio analysis, but we'll look at gross profit, equity ratio, and current ratio, and much more in greater detail later on. So there you have it, the accounting cycle. You start with a transaction, then you record this transaction in your book of first entry. You summarize this transaction in your general ledger. You make sure it's correct by the trial balance. You report of financial information in your financial statements, and then investors and business owners use this to analyze and interpret the information that was given to them, and then of course they can make a decision. If we are completely honest with each other, the disciplines of accounting hasn't changed much in the last 600 years. And the three elements known as assets, liabilities, and equities have truly stood the test of times and are still relevant today. So, what is an asset? It is a present economic resource that is controlled by the business entity, resulting from past events. This will result in a probable production of economic benefits. It should also be relevant to the business and be fairly representative.
What does this even mean?
So, let's look at it as a breakdown. The present economic resource is something that is scarce and that will be very useful for the business in performing their day-to-day task. Because of its scarcity, it's often expensive. Like an example would be a motor vehicle, land, buildings, equipment, and even machinery. And what do we mean by control? Control is a state of ownership. When the resource is owned, normally the entity that owns the resource also controls the resource. For example, a person that has proof of ownership or proof of purchase of a building. Such an entity is also responsible for the risk and the reward associated with that resource. Then resulting from past events? Well, it's kind of self-explanatory. It's something that took place in the past. For example, you bought that motor vehicle on Monday. It already happened. Probable production of economic benefits. By using the present economic resource for the near future, the business entity will earn money. For example, you bought that vehicle, now you're making deliveries with it, and that will earn you money. Then, relevant to the business, the resource should have been obtained to assist the business in performing their daily operations. And then, fairly representative. The asset should be fairly represented in the books of the business. They should have a fair book value. It's also important to take note that assets can be categorized in terms of how long they would be used by a business. We have non-current assets, that is a period of 12 months and longer, and this could be vehicles, lands and buildings, anything that you're going to use for a long time. And then we have current assets, and this is for a period of fewer than 12 months, and this is petty cash, banks, accounts receivable, anything that you're going to use within a year. Next up, liabilities. A present obligation resulting from past events which relates to the transfer of economic resources. This will result in a responsibility that cannot be practically avoided. A liability should be relevant to the business and be fairly representative. Again, what? So let's look at the breakdown. A present obligation, an urgent responsibility that has to be attended to as soon as possible. For example, you owe money to another business and you need to pay that back as soon as possible. That way, you will continue to be able to do business with them. Then past events, well, it kind of is what it is. It's something that happened in the past, like last Monday when you bought that vehicle and you took out a loan. Then transfer of an economic resource. A responsibility that has to attend to by the business due to a transfer of economic resources. A responsibility that cannot be practically avoided, and this is a responsibility that has been created and needs to be attended to as it cannot be avoided in a particular manner. Then we have relevant to the business. The present of economic resource that has been obtained to assist the business in performing its relevant operations. So that vehicle was needed to make deliveries, even if it was on a loan. Then fairly representative, asset should be of fair value in its books of the business. You can't say you loaned more or less money than you actually did. Liabilities are also categorized in terms of how long it will take before the business entity pays them off, and these two categories is non-current liabilities, which is a period of 12 months and longer, and this could be a mortgage loan or even a long-term loan. So the car that we just bought on 5 years, that would be a long-term loan. And then current liabilities is a period of 12 months or fewer, and this is accounts payable or short-term loans or even bank overdrafts. Equity. Equity is the total assets less the total liabilities. Regarded as the interest that the owner has in the business entity, equity is mainly consist of capital, income, drawings, and expenses. Okay, so this time it's a little less confusing, but let's still look at the breakdown. First, we have capital. Capital is the value of the asset that the owner contributes towards the business. Income, an increase in economic benefits during the accounting period that is not relevant to capital. Drawings, the value of an asset that the owner withdraws from the business for personal use. And then expenses, a decrease in economic benefits during the accounting period that is not relevant to capital. When we subtract the expenses from the income, we are left with either a profit, that's if the income is more than the expenses, or a loss, and this is if the expenses is more than the income. And based on this information so far, we can interpret the definition as follows, that equity is equal to assets minus liabilities, or we can even say that equity equals capital plus income minus drawing minus expenses. So there we have it, assets, liabilities, and equity.